Hare Krishna. Once again, welcome to my channel, Purposeful Prosperity. We are continuing to read our wisdom series from the Little Book of Common Sense Investing. And today we are going to the chapter number 9, titles When the Good Times Rolls No Longer Rolls. So there it says that it's always wise to plan our lower returns in the stock market and the bond market. So the financial planning should be always made considering the worst case scenarios. You cannot make your financial plan based on the best case scenario. That's a perfect financial planning. So let's just deep dive into this chapter. So Bogle is beginning in this chapter with an unfailing principle, and where it says that in the long run, it is the reality of business, where it says that the dividend yield and the earning growth of corporation are the one which drives the return generated by the stocks market. There is nothing else. It's just the dividend yields and the earning growths. So in this chapter, Bogle is introducing a concept about this PE ratio. So if you look at the definition of this basic PE ratio, it says that the price to earning ratio is often called as PE ratio and is calculated for the listed companies. It can also be calculated for the indexes like Nifty 50 or Nifty 500. And this is simply a ratio of market price per share and the earning per share. So if you take the P ratio of a Nifty, then it will be the market price considering all the 50 indexes and then the earning per share for the 50 companies. So that's how you get the P ratio for indexes also. The benefit of this P ratio is that it helps investor analyze how much they should pay for a stock on the basis of their current earning. And this also help us to identify if the market is undervaluing a company or overvaluing a company. Similarly, we can see when we do the P level analysis at a market index, then we can see if the market are overvalued or undervalued. So with P ratio, we can also modify this formula a little bit. So if you really want to see the price, then price will become your earnings and your P ratio. We can Bogle normally says P ratio as sentiment. So sentiment can be very high or it can be low. So a high P ratio means that there is some combination of unbridled optimism, excessive confidence, exuberance, and hope for a new reality. On the other side, the P can be or PE or sentiment can be very low, which reflected the deep pessimism, excessive fear, the widespread worried among investors. And then your earnings are your regular earnings. So these are the combination which going to derive the price here. So now we can see that there are three factors now. The first thing we find out that it's the earning and dividend, and the third is now the P ratio. So Bogle is further remembering his old quote, which has been mentioned in the previous chapter, where it says that the great British economist, Mr. John, has written 17 years ago that it's dangerous to apply to the future inductive arguments based on the past experience, unless one can distinguish the broad reason why past experience was what it was. I think we all are looking the past experience or the past data or different funds or different stocks. But if you are not able to figure out that why something has performed good in the past, then definitely you cannot indicate the future returns for that stock or the mutual fund because you don't know the reason. And if you know the reason and if you are convinced with that reason, then it's easy to predict the future returns for the mutual funds or the stocks. So here, Bogle is trying to help us understand uh, or get some arguments that why the past returns were like the way we have seen. So Bogle is continuing where it says that the what are the sources of returns in the stock market? And here he is trying to present a simple table of almost 115 years, where starting from year 1900. And we can see that your annual return is simply a combination of your investment return plus speculative return. So we understand that there are three sources. So your first one is your dividend yield, second one is your earning growth, and both these dividend yields and earning growths are called the investment returns. And then you have this PE change or the sentiments or the speculative returns. So all these three combinations is the one which gives you the total annual return. So if you sum up all these things, that's the way to get your total return. So we can see that your earning growth is very easy to predict compared to other things. And I would say, I think instead of earning growth, I think dividend yield is further actually simplified. That it's the simplest thing to predict because that's really depending on just one thing, that's the interest rate. Earning growth is depending on your three factors, and P is change, which is the speculative return. That's very hard to predict. We never know that when people will be really optimistic and greedy, and we don't know when they will be really fearful. So we have to really look into this speculative return and based on that try to guess the future returns by using all these three combinations. So here Bogle is trying to present a data of once again 115 years, and he's simply saying that this long data is really indicating that your speculative return is becoming more, that speculative return is adding additional return to you from a long period of this time. And since that's extra return is getting compounded, so you can see there is a huge difference getting created. Now, maybe you can ask that is there something we can see for the Indian market? And let's just see that how's the speculative return in terms of Indian market. So this is the data that I have got from the trend line, and uh, you can see that the red line is representing uh, your total returns, and your green line is something which is representing is your investment return. And we can see that in case of Indian markets, the speculative return is always negative. I think it was just the COVID time, post COVID, we can see where the market return exceeds the investment return. Otherwise, most of the time, if you see, our investment returns are below the market returns. That means the sentiments were not really good most of the time. So PE has not given much of the return. So if I really have to predict the future return, then I can use this past data to decide how the sentiments are going to be in future. So Bogle is further giving this data of total market return. So where he's saying that the speculative returns, if you look at the data from 1900, so if you look at the data of 100 years plus or 120 years, then this the change of this PE significance is really less. That's just 0.5%. Otherwise, whatever you have get is from earning growth and the dividend yields. That's the unfailing principle. But if you look at the short data of, let's say, last 40 to 50 years, their PE can make some significance impact. And that's what the data, at least for the US market, is suggesting that the speculative returns has added another 2.9%. So that's why we are getting an additional return during this period since 1974. So when Bogle is trying to predict the next 10-year return, he is thinking that the since in the past 30 to 40 years, the PE was at a very high level, and since based on the reversion to mean principle, he is saying that the return from the PE now can become negative. So that's another once again a guess kind of a thing. And here in the for next 10 year, he is returning that a speculative return can become negative. So there can be a loss of -2%. And earnings and dividend yields will be easy to guess. So based on that, he's trying to predict the US market return will be 4%. So now based on this a calculation and whatever we understood in this chapter, this will help us to put some reasonable expectations from the stock market return for the coming decade. So we have to really understand that Bogle is not trying to predict your returns for 1 year, 2 year, 3 year, or 5 year. He's talking about a decade. So that means a 10-year period. So if you take a 10 years of period, it's really easy to predict these dividend yields, the earning growths, and the sentiment. Although you can be wrong in predicting those things, but there are higher chances to predict these things. So here Bogle is saying that for the corporate earnings, so we always assume that they will continue to grow the way it is growing right now, and that's about your the GDP of your country. And we also call is the nominal growth rate. So your nominal growth is your real GDP plus your inflation. So if you take the data for India, so I think our real GDP is around 6.57%, and we have the inflation also between 5 to 6%. So if you take this data, then we can see that okay, 12 to 13% is the nominal GDP growth that we can expect in general. And if you look at the past 15-20 year return of a Nifty index also, it was close to 12 to 13%. So this gives, so we can assume that it will continue to grow the way it has been growing. It can grow even faster also or a slight lower also. But for 10 years, there will not be very huge differences between the GDP growth because that's quite linear kind of a thing. And so next we can assume is that let's assume that the current Nifty PE is 20. So if we take these two data, then now there are three possible scenarios. So one thing is that after 10 years, your PE is going to remain at the same level. So if it is going to remain at the same level, so whatever is your nominal GDP growth, that is what your returns from the stock market is. So if your normal GDP of your India is growing at 12%, so your returns will also be 20% after 10 years. Now, there are two scenarios. One is extreme uh, greediness and the bullish scenario, where we can say, okay, the Nifty PE can become 30, 20 to 30. So that's an increase of 50%. So in this case, since in a 10-year, the PE has increased 50%, so yearly impact we can consider of a 5%. So that means we are getting a return of your GDP growth plus 5%. So 12 plus 5, so 17% return is possible if this scenario, the bullish scenario, really works out for the next 10 years. The second scenario is that where extreme pessimism comes in the market, people, investors are really fearful about their investments, then your PE can go down and it can go up to 15. So that means from 20 to 15, that's a decrease of 25%. So a 25% impact for a 10-year can cause this 2.5%. So that means your return will be GDP minus 2.5%. So once again, if you say 12 minus 2.5, so you will get close to 9.5 to 10% of return. So these are the three possible scenarios. So definitely everybody can think about these things, and based on your judgment, you can try to put whichever scenario fits best for you. But I think we should be always ready for the worst case scenario. So if you make your financial plan based on the worst case scenario or the realistic one, so that will really help you to make a very good financial plan for yourself. So one more thing here I like to add. So if you look at this impact of PE, it will be really huge for a short duration. Since we have taken a 10-year time period, we can see that the per year impact is just 5% or the 2.5% in a negative scenario. But if this has to be done for, let's say for 1 or 2 years, let's say for a 2 year scenario, then if your PE drop increases by 50%, then you have 25% per year gain additional just because of the PE. And similarly, you have 12.5% of per year negative return just if their PE become 50. So we can understand in a short scenario, the significance of PE is really high. But if you talk about a long scenario and we are talking about a minimum of 10 years, that's where the significance reduces a bit. But still it has an impact. And if you take a really, really long scenario, when Bogle talks about the 100 years, then the significance is pretty less. So that's 0.5%. Uh, so that's about the realistic expectations for this coming decade. So feel free to look into this data and try to guess that uh, what will be the return Nifty is going to give in the next 10 decade. You can note down these things, and maybe after 10 years, you can try to see that, okay, what you were thinking at that point of time and what actually happened. So these kind of writings are really going to help us and grow and make you grow in terms of your wisdom and become you a better retail investor. So continuing with this equity market return, now Bogle has added about these bonds also in this chapter. So this is the first time he's introducing about the bonds. And he's saying that the reasonable expectations from the future return of bonds are pretty simple compared to the stock market. And the simple reason is that your stock returns are depending on three things. One is the earning, you have dividend, and you have the PE ratio. But in terms of bond, the single dominant source is prevailing interest rates when the bonds were purchased. And if you look at this graph on the right hand side, you can see that they have a very strong correlation. So your returns from a 10-year bond and your interest rates. So there is a 0.95% correlation. That's a very strong correlation. So it's really easy to predict that what your return are going to be for the bonds if you are going to hold them till maturity. Uh, so we can see that the initial yield whenever we are purchasing the bond, so that proves to be a reliable indicator for future returns. So in between, since we are here, he's taking up an example of a 10-year bonds. So he's saying that between these 10 years, the interest rate can go up and down, and that can really change the your bond values. But then if you really hold the bond till maturity, then all these fluctuation does not matter because your interest rate yield has been fixed at the time of purchasing the bond itself. So that way we can, if you are investing in bonds, which Bogle is suggesting in further in this book, and we'll going to deep dive into this further. But if you have some bonds in your portfolio, then I think it's really easy to predict these things. Uh, Next, Bogle is trying to give some data for us where he's saying that he's constructing a portfolio of 50% long-term government bonds and 50% of long-term corporate bonds, and he's talking about only investable grades. So if you talk in terms of Indian market, so it will be like AAA in corporate bonds. So when he's consisting this kind of a scenario, he always say that the government bonds are going to return slightly less compared to the corporate bonds. But if you construct a portfolio of this 50-50 thing, then he's saying that you can expect some good returns. And he's saying that looking at this data, we can see that if you look the 100-year data, then your total returns are almost quite similar to whatever you are getting the interest from your bonds. Uh, but if you look at the short-term thing, there is a difference of 1.1% additional since from 1974. That's because Bogle is trying to put an argument there because that's a really long time where interest rates were low for a quite a long duration, and we have a really good bull run in the U.S. market, and that's the reason here because the bonds capital appreciation happens in the bonds when the interest rates really tumbles because you are getting your interest with, depending on the yield that you have, plus your bonds are also getting capitally appreciated. So your returns are definitely going to increase. So he's saying that since from the last 20 to 50 years, 20 to 40 years, the interest has been really increased. So for the next 10 years, if he has to guess, so then he's assuming that the next 10 years can be a scenario where interest rates are going to increase. So if they're going to increase, then your bonds values are going to go down. And so in this case, he is saying that your returns are going to match with whatever yields that you are going to earn. Uh, Further in this chapter, Bogle is trying to construct one more portfolio where he's saying that the 40% you have stocks, 60% you have in the stocks and 40% on the bond. And these bonds is also a balance we call it as a balanced portfolio. We also heard about the terms of balanced mutual funds. Uh, so here we can see that the return uh, from this. So if you have this kind of a scenario, then definitely you can predict the next 10 year of your stock market return. You can also predict the next 10 year of your bond return, and based on that, you can decide what is your return going to be. So that's something you can look at the past data of 100 year. or look at the past data of 20 to 30 years, and then based on you can try to guess the data for the next 10 years. So we can try to do something similar for the Indian market also. Feel free to do that thing, guys. So that can be a homework for all of you, and that will give you some understanding because depending on what kind of a balanced portfolio that you have created, and that will help you to just your next 10-year return. And especially for the US market, the Bogle is predicting legally really low return for this balanced portfolio because he's assuming that the future is going to be really low for the US market in terms of equity return as well as for the bond market return because interest rates he's expecting to go higher, and I think that is what happened currently also. So your bond returns are low and your equity returns are also going to be low. So that's what his prediction for the next 10 years. And he always says that you can always be wrong in these things, but then you are trying to make the best possible guess depending on the past data and your logical reasoning. So that's about the common sense investing. And further, Bogle is trying to add is that if you look at the this balanced portfolios or balanced mutual funds, there the interest rates are there, the expense ratio are really on a higher side. You see sometimes it's between 1.5 to even 2.5%. That's really huge. And if you have this much uh, of expense ratio, then getting a good return will be really difficult. So let's say if you have 2% expense ratio, so your return will reduce further 2% from this 3.6% which he's expecting in the next 10 year, and your return will be just 1.6%. So that's something really low. So we have to make sure that we don't select these balanced mutual fund. Instead, we make our own portfolio of both equity and debt, and we do the rebalancing maybe once in a year or twice in a year that we can do, and that way we can really reduce the expense ratios here. So Bogle is further adding is that so unless the fund industry begin to change by sharply reducing the management fees, operating expenses, sales charges, and the portfolio turnover and its attendant cost, the higher cost actively managed funds appears to be singularly unfortunate choice for investor. And if you look at this chapter, I think he's simply saying that these high cost balanced mutual funds are completely no. That's what at least I learned from this chapter. And we can see that SEBI is also working on different papers and different articles, and SEBI is trying to put some cap on these expense reports, which are expense ratio which has been charged. I think currently the expense ratio of index funds are also pretty high compared to the US and India. But over the time, I think the kind of action SEBI is taking to protect the retail investor, I think it will go down further. And SEBI is also trying to put multiple caps. I think we have seen that some time back there's an article that your expense ratio should be based on your performance. So there are multiple things which SEBI is thinking of it, and I think over the time soon, either they will reduce. Otherwise, if they are not reducing these management fees and the expense and the cost, and if you are investing in those mutual funds, then for Bogle they are the unfortunate investors. And we really want to become fortunate, not the unfortunate one. So the choice is on in our hand. Further in this chapter, Bogle is continuing and it says that there are 5 ways to avoid financial devastation. And the Bogle talks about the 5 things. So he says that the first 2 things, which works also, the and which is that you select a very low cost index fund and simply hold the full stock market portfolio. And second thing he is saying that if you are really not convinced with that index fund, or if you really like to diversify, then you can select other fund which are again at a rock bottom cost and minimum portfolio turnover and no sales load. So if you can find such an active mutual fund which where the cost is really low and the per portfolio turnover is minimum, then you can select that portfolio, that mutual fund also, and you can create a portfolio of your index plus that active mutual fund, but make sure your cost should be rock bottom. So if you take these 2 approaches, then he is saying that you can avoid financial devastation. Apart from these 2 things, there are 3 other options also. And as per Bogle, they are not working. So the first one is saying that you select the winning fund based on the past performance. Second is that you select the winning fund based on the recent short-term performance. And third is that you try to get some professional advice in selecting a fund which can outperform the market. So he's saying that the chances of getting successful with the first two options are much better compared to the last three, because your failures, you have a high probability of failure for the last three options. So we really want to go on a path, select a path where of odds of our success are high. Further in the chapter, Bogle is saying that for the markets in total, uh, the amount of value added or alpha must sum to zero. And because one person positive alpha is someone else negative alpha. I have seen at least, or I have observed that I think while selecting the mutual fund, one of the parameter people look is about the alpha. They say that okay, higher the alpha, better the mutual fund. But then we really have to understand that in a fully aware market, if one fund is having a higher alpha, there can be another fund which is going to have a negative alpha, because we understand from the previous chapter that these fund manager doesn't create wealth. It's the corporations, the dividend growth and the earning yields. That's the one which is creating the wealth. So definitely, if one is gaining, it's other one is losing. So that's why Bogle called in the beginning of these chapters a zero-sum game. And I think Mr. Jerry is also saying something similar, that this alpha is going to be zero, a sum of zero. So collectively for the institutions, mutual funds, private banking areas, the aggregate alpha return will be zero, and it can be negative if you consider the transaction cost, which all of them are having. So this is really important for us to know, and we have to understand that this alpha is not coming from some air. There is no magic which your fund managers are doing. So if you take this thing, then I think you will be really convinced that investing in a passive index fund is the best scenario. Further, Mr. Richard, once again a CFA, he's adding a couple more insightful instructions for us, and he's saying that the facing the dual challenges of market efficiency and higher cost, investors are continuing to shift assets from active to passive management. And I think that trend has already started. Even if you look at the India, how your passive funds have been growing, that's really tremendous from last couple of years. People are getting aware about these things. Now I think everybody knows that there is no point in investing in an active large cap fund. Better you should go for an index fund. So similarly, these knowledge will keep on growing. And I think I'm sure that at some point of time we are going to see that even the mid caps and the small caps also will not be able to beat the indexes. And in the previous chapter, we have seen that Bogle has already told us about that since the benchmark comparison is not good, we are not comparing with the momentum or the value indexes. That's why we are not seeing the real picture. And Mr. Richard is further saying that the impetus for this move will be growing realization that higher cost are the main cause that even the skillful managers are not able to give a good performance, because cost is cost, your money is getting deducted. So if you are charging 2% or 1.5 to 2%, then your AUM amount itself is getting reduced. So because of these charges, even if you perform once again a 2% on top of index, you are still matching with the index only. So you really have to perform very high, and the chances of that kind of a thing to do for a very long duration, it's almost negligible. So as per Richard, if you really understand these things, then you will be also started shifting your assets from active to passive management and feel relaxed. That's a way of a style of investing. Because because Warren Buffett always says that your money should be working for you even when you sleep. So and passive investment is all about doing that thing, because you don't worry about, you are not in a worry to beat the market. You are not checking every 3 months, okay, am I beating or am I below? So there is a lot of anxiety you are getting created if you do this active management. So all that anxiety can also be reduced by this passive management. And that's my take on this one. So once again, thank you for being with me. I hope you guys make something out of this thing. I think I know that there are a couple of terms which have been introduced here about portfolio ratios. We have hands about the bonds. So feel free to go through this session one more time. And if you have any questions, feel free to ask. If you really like this kind of a content that we are creating, then feel free to like, share, and subscribe to my channel, Purposeful Prosperity. And I will continue to bring such knowledgeable sessions to extract wisdom from different books and to make you a better retail investor. So thank you once again. Hare Krishna.